It's almost like you get the dopamine hit on the positive effect of watching your balance go down rather than getting your dopamine on the 20-minute excitement of the new shoes.
You're comparing apples to oranges because you're not staying in that home for 30 years. So you don't even get to make these, I saved this much in interest. No, you did. You moved 7 years in. You didn't save anything in interest.
Build the game plan into figuring out how you can get into it, but just get into it. Be sure you know what you're getting into, because the people that taught you to get into 30-year mortgages are the same people that are.
Hey, welcome back. Another episode of Remnant Finance. We've got with us a friend of mine, Harrison George, who's actually helped us or helped me secure the mortgage on my current house. So we became friends through that thing, and I want him to have an opportunity to talk about what he does because it's a phenomenal product. But what's up, Harrison?
Hey, how's it going, Brian? Thanks for having me on here. Hey, Hans, how's it going?
Hey, it's good. It's good. I'm excited for this.
And I'll just go ahead and kick off real quick with just a little short bio of Harrison, just to get that out of the way, and then we'll hop into the conversation. So he was born and raised in the heart of the Bay Area, grew up surrounded by one of the most competitive, fast-moving real estate markets in the country. That early exposure sparked a passion for real estate and finance that's taken him across state lines and into the lives of over 1,000 homeowners. After completing his education in Colorado, Harrison made his way to Idaho, where he currently lives. That was in 2018, expanding his reach and his licensure to serve clients in 47 states. Is that still current, Harrison? 47?
Yes, 47, 48. I think we're somewhere around that range.
Who are we missing?
I think Utah and New York.
All right. You might want to stay out of New York. I know they're difficult in the insurance industry.
It's tough there. It's
Anyway,
tough.
his mission is to help everyday people unlock homeownership, build wealth through real estate, navigate the mortgage world with confidence. He's now a nationally recognized top producer, and in fact, the number one producer of the loan we're going to talk about today in the entire country. He's known for strategic approach, deep industry knowledge, and ability to find creative, but not always responsible financing solutions. From innovative options like the all-in-one loan, which is going to be our focus today, to down payment assistance through Home Fund, Harrison brings a modern edge to mortgage lending, one that prioritizes clarity, trust, and long-term success. With his team, it's more than just closing on time, although that is non-negotiable to him. It's about building real relationships. And that's true. I can speak to that. We've actually kept in touch since I've moved and have worked with Harrison. He and his team don't just want to help you buy or refinance a house. They want to be your go-to resource for the rest of your life. All right. So now that's out of the way, man. Let's talk, just give us a broad overview, if you will, of like what your number one thing is.
Totally. And I'm going to circle back real quick. So we want creative and responsible financing solutions, not responsible. Just to clarify that, we want to remain responsible.
So
I was wondering when you said that, I was like, I don't know if that's.
I read it wrong, but always responsible.
Yeah, you definitely said, but not always responsible.
Yeah.
I do. Yeah, it's funny now.
Yeah, don't worry. We always ask for people's blood samples and their kidneys. We'll figure out a way of getting you guys into a loan at the end of the day. I'm just kidding.
That's hilarious. Reading isn't my strength, I guess, but there you go. Always responsible.
Yeah, I mean, so
very important point of clarity.
I agree. I mean, just a little bit about my idea and really what I really enjoy and love what I do is I don't think there's many other jobs or occupations in the country that really allow for you to talk to new people, learn their life, and understand some of the hurdles that they have. And it's kind of become really apparent to me that most of the hurdles that any one individual faces is pretty standard across the board. Hey, look, I'm in this situation. Something happened in my past, maybe 2008, or something happened during COVID, and there was this turn. And now I need to figure out how to set myself back on track. But I'm so busy just trying to stay on this balance beam that it's hard for me to decide where I need to put my arms in balance over here. And I think it's a really unique position to say, hey, like I'm in this third party position, and here's some suggestions of maybe changing some of these tactics in your life that maybe require for you to take a step back, get back onto the highway as opposed to trying to blaze your own path through the mountains. And then let's start taking off to help you achieve your goals. I mean, I'm a huge proponent and tell my team and the people I work with, like family is number one. Walk right in the eyes of the Lord and make sure that you're doing the right thing there. In my opinion, that's what I personally believe, but also trying to make sure that you're not spending every waking second from 4 o'clock in the morning to 8 o'clock at night just trying to pay for that next bill so that your kids can have that life. Because I think that the life that your kids want is time with you, and figuring out how we can change that mind shift. And that's one of the best things about what I do is I just get to talk to people and say, hey, look, like, how can we put more time back in your life? It's the one thing that no matter how rich you are, you don't get any extra time on this planet.
Yeah, absolutely. It's even more scarce than land. And we believe invest and work to live, not the other way around. Don't
Yes.
live to invest and work and be worried about money and always how to do that, because yeah, time is a very scarce resource in our life. So what a lot of people talk about, and if you get on the internet and look up or look up some, mortgage strategies and stuff, it's often termed velocity banking. I think it's a
Mhm.
great term. I think what you do makes it easier, because if you go into velocity banking and you watch some YouTube, and I even recommend that to people just to get a good idea of it, because we probably can't clear this up in the 45 minutes we have remaining to a 100% certainty. But it's going to be convoluted and more difficult in the traditional sense of how people do velocity banking. Your loan, the all-in-one loan that I purchased through you, takes care of that in one fell swoop and simplifies that process. But can you kind of give us, like, I don't want to say the elevator pitch because I think that's
Yeah.
impossible, but an overview of what velocity banking is and why, like, the all-in-one works and what the all-in-one is. That's probably a
Yeah.
better place to start, why it works.
I mean, velocity banking, kind of, if we're to do the elevator pitch, and I'm going to do a terrible job at explaining it, it's really just figuring out ways of offloading and paying off debt at an accelerated rate by utilizing tools that are available to us and to everyone in the United States above and beyond what the traditional banking institutions have taught you. Oh, hey, you make your payments, you pay your credit card bills, and you pay your vehicle loans, and so on and so forth, and you should pay them by the 27th, and that's it. Sometimes you can even pay your interest only payment. Sure, you can do that, and in many instances that's required because it's hard to make extra payments if there's not a lot of extra money left around. The hard part is that you get a car and it's a $40,000 loan, but you have a $900 a month payment. It's like, oh my gosh, it's $40,000 costing you $900, when that $40,000 in, let's say, a mortgage is only going to cost you, I'm throwing numbers out, $180 or $220. There's this big discrepancy in money out versus money potentially being able to be retained. So the velocity banking is, hey, how can we pay off debt at an accelerated rate? And the all-in-one kind of takes not just debt, but home debt as well. There's the consumer debt, and then there's mortgage debt. The all-in-one is a combination. It can be done on a purchase or a refi, and there's plenty of information that we obviously have as well that can show you exactly what it can and can't be utilized for. But for residential properties, it's this big line of credit that allows for an individual to get access to 80% of the value of their home in the form of a line of credit minus what they owe. So if they're refinancing a property, let's just say it's a $500,000 property, they get a line of credit of 400 grand. And if they owe 150, well, that $250,000, that's the difference they can use to deploy and pay off other debt. But the real differentiator between this product and a 30-year mortgage is 30-year mortgage, your payment's based off what you borrow. So whether it's month 1 or 121, your payment's essentially always going to be the same, the principal and interest. With this product, because it has that integrated checking and savings account, so every dollar I earn goes to my mortgage balance. And as that money gets deposited in my balance, my payment is now based off of what I owe. So if I put in 10 grand, I now have access to 10 grand, just like you would in a checking and savings account. But because it's sitting there, even though I know I need to pay my credit cards down later or buy groceries and gas and diapers and whatever else, it's taking consideration and saying, great, now you owe $10,000 less. Let's calculate your payment off of $10,000 less. And I have access to that money just as easily as I do in a checking and savings account. So if I pull out $4,000 to pay my credit cards off, yes, my balance goes up, but now I'm $6,000 lower at the end of that month than I was the previous month. So hyper efficiency with debt payoff, but still giving you access to those funds. And that's the benefit of a product like this. Interest rate's not the most important part. It's nice, but it's completely different than a 30-year mortgage when just looking at the overall math of the product.
Can I ask a few questions here
Yeah, of
for
course.
clarifying? Because my role in this is I don't understand this yet. And so
Okay.
for most of our listeners who are being exposed to this for the first time, who have these questions coming up, I'm going to try to jot them down and ask these questions just to get some clarifying information and hopefully make it easier to digest for
Yeah.
someone who wants to explore this. So going back to your example, 500K is the home you purchase or refinance. Well, in the example you used was refinance.
Yeah.
You have a home with a $150,000 mortgage, it's worth 500K. So then you guys would look at that and you'd say, okay, well, we'll loan you 80% of that. So that would be 400,000 less what you owe currently on the mortgage of 150. So we're going to give you a line of credit of 250,000. Is that correct?
Great question. No, your full line of credit, like a credit card. If you have a credit card with a line of credit of 10,000, but you owe 5,000, you have access to that remaining 5,000 in the credit card. But if you paid the credit card off to zero, you still have the total $10,000 available funds. Same concept in this product. So you have a $400,000 line of credit, but because you have 150 outstanding, your available out of the gate is the difference. But if you happen to have 50 grand at Wells Fargo and you moved it into this, you now owe 100 grand. Well, the gap now just increased. Now you have the difference between 400 and $100,000.
And in that refinance example, are you guys taking over that note? So you're paying off the previous lender and now you have the note for 150K and extend them 400K total line of credit, but effectively 250 that's currently accessible.
Exactly.
Is
It's
that
a
right?
full-blown
Okay.
refinance at the end of the day. So we pay off the old one, they get a whole new financing instrument on that. We'll create the
Okay.
bank account after a couple weeks after closing. They get all of that banking information. And if you spend, Brian, you could probably attest to this. If you spend 20 or 30 minutes on the web page, it's not like it's the most confusing web page at the end of the day. You can go and say, we can get more granular. You see your checking account and you see your line of credit. The checking account is the thing that puts money in and pulls money out. And the line of credit is just the mortgage on it. So you put your money into the checking account and it does the automatic sweeping for you.
Yeah, and so I think that was something that I wanted to address that was like maybe left off for somebody not listening is the reason it's all in one is it is a checking account and a mortgage or and the HELOC all in one product. Now they're separate in that I have a checkbook, I have a debit card, and I have a checking account with, the account number and the routing number. And then attached to it, so literally attached to the hip is my mortgage.
Yep.
So like right now when I look, I have the mortgage balance in the all-in-one account and my checking account balance is zero. The
Mm-hmm.
reason is yesterday I had a deposit of a couple $1,000s from an income source. So yesterday, if I looked at this, there would be a green number that would have said, I don't know what it was. Let's just say $3,000. Well, today that swept or the mortgage automatically reached over into the checking account, grabbed that money, pulled it into the mortgage, and my mortgage balance went down by $3,000.
Yeah,
So today, my daily interest rate is being charged on a balance that's $3,000 less than it was yesterday. And
exactly.
all mortgages are calculated on a daily interest rate charge. It's just all factored in on a 30-year term so that it knows exactly what it's going to be on schedule.
Mm-hmm.
Whereas when I do this, if I deposit $50,000 into my checking account, tomorrow my mortgage balance is $50,000 less. And just the opposite works. As a matter of fact, I'm waiting for the check to come out. I just bought a zero turn mower for about $8,000. So one of these days they're going to cash that check. I wrote them a check, a paper check, and my mortgage balance is going to go up by $8,000.
Hmm.
So I wrote that check from the walls of my house, with which in a traditional mortgage that's locked away unless I can convince a bank to give me a separate HELOC. Now it's all in one product. Does that make sense, Hans?
Yeah. And so you're essentially what you're doing is you're capturing some interest rate advantage anytime you have money sitting in your checking account. So if I have a separate mortgage and I have a checking account separately with cash in it or a savings account, if the primary interface of this is the checking and savings component, essentially that $8,000 that you had sitting in a checking account if you're planning to buy this mower was doing nothing for your mortgage before, but now by being housed in here, it gives you a period of however long it's in there of reducing your daily calculated interest rate. That's
Right. And
correct.
every day they delay cashing that check, which I hope they're really slow moving on that. I'm
Yeah.
benefiting right now.
Exactly.
Yeah. And How frequently is that sweep? You said that it's swept
Daily.
into the mortgage. Is that
Yeah.
daily?
So to get specific, at 11:59 Eastern Standard, any money in the checking account on a daily basis is swept into the mortgage. And then at midnight, the calculation is done on technically the previous day, the 1 minute earlier, based off of that new reduced balance.
So
Wow.
unless you have daily deposits of income going into your checking account, the majority of the time, so if you're somebody that gets paid every 2 weeks, there's only going to be 2 days a month that it shows a balance in your checking account. Unless you push money to it, which I could do in preparation for like something, maybe I want to do like an ACH transfer to something else.
Yeah.
I'll push the money to the checking account 1 day prior and then it goes out. So
And can you have
I have a zero
direct
balance
deposit?
not most, 20 days of the month, let's call
Yeah.
it.
Can you have a direct deposit to this? Like, for instance, well, so I see you're shaking your head that you can do that, but our listeners, a large majority or a large portion of them are military, and DFAS, the agency that pays military, is trickier to work with. And so, like currents that we use, DFAS goes directly into currents, but it takes a little bit. You have to figure out this kind of a workaround or figure out the right way to do it. So in this case, DFAS can deposit directly into your checking account that's part of your mortgage. And then,
Yep.
wow, okay. And
Yeah.
I'm not pretending like I don't know this. I'm learning in real life, and I'm like, I know you've explained it to me before, Brian, on the phone, but now as I'm actually writing it down and kind of picking it apart, that's
Yeah, so I still
crazy.
have the situation as still being a reservist, and all my pay from the reserves deposits directly, and it's with a bank. You can look it up. It's North Point Bank
Yeah.
is who handles the product side of that. It's just a bank account. So
Yeah.
just like if you wanted your deposit or your paycheck to direct deposit into USAA or Wells Fargo, you're just now going to put the numbers for North Point Bank, and it'll flow right into it.
Yeah, I mean, the best way to look at it is almost like any bank account that you've ever experienced has all the same functionalities as this bank account, except this just has a couple extra steps that's tied to your mortgage. So if you wanted to do mobile deposit with your cell phone, personally, yes, you obviously do get a debit card. To be honest with you, I shredded my debit card because if I use it and I pay for a hamburger, then my mortgage balance goes up by, well, nowadays hamburgers are like $20, but my mortgage balance goes up $20. If I could put it onto a credit card, maybe I get points that can help me pay for the next flight that I need to take. Yeah, sure, it's something, and I'm paying that off maybe in another 15 days, but I'm taking advantage of that 15 days of the bank's free money. So I'm just using the tools that are out there to my advantage.
Yeah, and that's exactly like I used to be almost neurotic about paying off credit card balances, like almost weekly or anytime income came in, I'd zero them out. And now almost everything we spend is with a credit card. And I only pay it off once a month, like no
Correct.
matter what. So that entire month, like the credit card is holding all the spending. My my mortgage is lower. It's so all the deposits for the whole month are lowering my mortgage, giving me a better effective interest rate, or not interest rate, but a better effective interest efficiency, I should
Yep.
say. And then at the end of the month, my mortgage balance goes up because I pay off those credit cards. But I've got 31 days of a reduced interest charge on my mortgage because I floated it into the credit card for a whole month.
Yep. Exactly.
And I get all the
So,
points. And then I take the cash back and I put it into my low stress trading account.
Yeah.
okay, what type of properties would this like? Is this just for primary homes, or could you refinance a rental property? What are the restrictions on what you'll consider in either, like I have 3 rental properties currently, single families. Is this something I could do with that, or does this have to be a primary home? Like what kind of restrictions
Yeah. So
do you look at?
currently it's residential properties, 1 to 4 unit, primary homes, homes, and investment properties it can be utilized for. It cannot be manufactured homes or geodesic domes or land or anything like that. We do have a construction loan for this. We can get into that later. There's just a couple extra steps, but really it's just 1 to 4 units, primary, second investment. We're working and going through the process of being able to do this on commercial. Not sure when that's going to be available for individuals, but that is the intention. We're trying to have this be, from credit cards to personal lines of credits to vehicles to maybe even looking at trying to figure out how we can do it for student loans, anything that you can think of. We're trying to have this, calculation done on any potential debt that an individual is taking.
I want to try to channel like what listeners who have never heard of this would be thinking.
Yeah.
All right. So with our audience, a lot of them have been exposed to RP Capital and our friend Shane Thompson in setting up turnkey rental properties. And so I'm thinking wheels are turning for myself. I have 3 properties right now. Now they're all on the 150 to 200K value, at least at the time of purchase, in that ballpark. In other strategies, like looking at a cost segregation analysis, I know there's a cutoff point where this doesn't really make sense. So what if someone has a couple rental properties, like currently I'm renting in Coronado, I don't have a mortgage here. I will definitely be in contact with you when we move to New Hampshire in 2027. But for now, if I have rental properties and they're on the low price point, they're single family homes that are under 200K, is there a certain amount of equity that I need to have in the home, or that I should have in the home, that would make more sense to make it more optimal? What are other thresholds? Okay, so it's an investment property, so okay, check, we can do that. But when would it not make sense as far as home value, how much the mortgage is outstanding, et cetera?
Yeah, great question. So I'm just going to kind of hit all of the designations. So for primary residence, technically, yes, you can do 10% down, or in a refi, you could go up to 90%. Not as a cash out on primary residences. As a rate and term, you can go over 80. Cash out in the world of the lending, at least for this product, anything available of more than $2,000 is considered a cash out. So if they have access to more than 2,000, let's say they owe 100 grand on $1 million property, they can't go up to 900 grand because that line of credit would only go to 800,000. For second homes, it's 80% no matter what, meaning you need 20% down or you need a 20% equity position, whether it's a purchase or refi. And then investment properties, you can do 25% down. That's the minimum down on investment properties for a product like this. And then you can, if you wanted to refinance, cash out goes to 70% and rate and term goes to 75. But so for fast math, you could just say you can do 90 on primary and you can do 75 on investment.
75 on investment, 75% loan to value.
Yeah.
But wait, can you go back, because you lost me at
the
cash out versus I don't even.
Yeah. So you talk about the cash out part.
Well, you said you can do either cash out or you can do like rate and like
term.
Those two terms that you just used. Can you elaborate on those?
Yeah. So cash out is having access to a line of credit of greater than $2,000. So if you have a rental property, let's say the value of it's 100 grand, but you owe 50,000, then the max you could get access to would be 70%, because that available line that you'd have access to after the closing costs get added into it, which is all standard traditional closing costs, like a normal 30-year mortgage. But if you happen to owe, let's say, $71,000 on this $100,000 property, well, you could go up to 75% because we can wrap those closing costs into it and bring you up to that 75% loan to value.
Okay. I need to think more about that one and study more.
Yeah. It's pretty, but I mean, that's kind of like the standard guideline. We've seen people get the cash out up to 75%. So for just simple conversation, you can just say 75%.
Okay. Cool. So 75% on a rental property.
I want to ask you, who is this product not for? Because I think you have to be a decent steward of your money, in my mind, for this to be beneficial. So who would you not like? If somebody called you, who would you say, hey, I can't really recommend the all-in-one to you?
Yeah.
Based on what?
Some of the prerequisites for this: primary residence and second homes, we need 700 credit scores. These are all kind of, hey, if you hit all of these, it seems like this might be a really good solution for you. If you miss one of them, we can certainly work on helping you get into it. But primary residence, 700 credit scores; investment property, 720. We need to see lower debt to income ratios. Obviously, you need that equity position, 20% down, 25% down. So all of those are kind of saying, hey, this might not be for a first-time home buyer that's wanting to put 3 or 3.5% down. And then lastly, outside of the down payment, we need to see reserves dependent on your loan, depending on the line of credit you have access to. So we need, again, that scenario, $500,000 purchase, $400,000 loan amount. We need to see reserves of 10 or 15% of that line of credit. So 40,000 or 60,000 elsewhere: checking, savings, stocks, bonds, 401k, cash value, whole life, and so on. So those are all kind of saying, hey, we're going through and slicing these people out, saying, hey, you're not just right qualified for these individuals, or sorry, for this product because of all these designations. You know, one of it's possible you may meet all of these, by the way, and it still might not be the right product for you, because this product is mostly beneficial for people who are positively cash flowing. Hey, I make
Yeah.
10 grand a month, but I spend $9,800 a month. Well, why? First of all, do you have all these other expenses that you're paying off? Cars, credit cards, personal lines of credit, and so on. Is that something we can wrap into this? We want to see people retain at least 15% of their net income or more monthly to determine if this is a product that's going to be right for them.
Yeah, and that's one of the things I was thinking. If you've let your lifestyle inflate to the point that every dollar that comes in your life also goes out, this could become a disaster over time. Like the benefit, this thing is so powerful and I love it, but you have to be spending less than you make, I think. At least the majority of the time. Like the large majority of the time. I'm not even talking 51%, 85% of the time, because we all have months that like the money just flows out of your life, you know?
Yeah.
And that's okay. And actually, this can help save you in those emergency times. But if 85% of the time I'm arbitrarily picking that number, I'd say you have to be cash flow positive and with 10, like you said, 10, 15+% more for it to
Yeah,
make
good
sense.
stewards of your money. Yeah, I think you said that just a minute ago. You have to be good
Yeah.
stewards of your finances.
That's one thing that psychologically I was thinking when it sweeps every night, if you're used to having a checking balance and every night you look at, or every morning you wake up and you see zero in that balance, you have to understand that that has moved into the equity, but it's still accessible. Is that right? The right
Yeah.
terminology? Like it's moved into the equity of the home, but it's still accessible via this line of credit. And so you have to have the diligence at that point. It's like once you unlock that in your mind and okay, I do have money, it's just it's under a different wrapper now. You then have to have the discipline to know, okay, just because it's saying zero and knowing I can spend still doesn't mean it's just a blank check to spend recklessly. So it's a lot of the conversations that we have about clients that want to set up IBC, cash flow and your savings habit is a big part of the discussion. And it's not that the tool doesn't change, but your behavior with it could put you in a bad situation. If you are already in the habit of not saving, you could dig yourself a hole with IBC, even though the tool itself is powerful. So it's good to know yourself. And I think that if you're the type of person that regularly pays off your credit card every month and it never pays interest to the credit card companies, that's a good indicator perhaps against someone who continuously lets that credit card debt build. Because if you let the credit card debt build, you might be the type that you might have that tendency to, okay, well, I can access this, so I'm going to spend it. And now you could kind of work backwards in a sense.
Exactly. I mean, this is just like Ryan was indicating a second ago. It gives you a little extra time for those individuals that may have really inconsistent income. Some months might be really big, other months might not be anything at all. Months that they have good income coming in, great. They have this big available funds that can also allow for them to kind of weather the storm. But while they're waiting to do it, it's reducing their mortgage payment because, again, their payment's only based off what they owe. So if they're saving an extra $200 or $300 or $400 a month because their balance is lower, most people aren't just going to say, well, hey, I saved an extra $500 this month because my mortgage payment's lower. Let's go spend an extra $500. That's now just working for them almost kind of continuously, which is the big mental shift. You really have to change how you think for a product like this.
Yeah, and another little shift that wasn't readily apparent when I first talked to you, but I figured out pretty quickly, is that there actually isn't a mortgage payment. So like what I mean by that is when you compare to the conventional loan, it's
Yes,
like the first month you have this payment that's due of, let's say, $3,000, part of its principal, part of its interest. With this, it's just because you're constantly paying principal down, that is sort of not a part of the factor. What the principal balance is determines what the interest for the month is, and
yes,
that interest charge just tacks onto the top
exactly.
once a month. I think it's like the 19th or
The
something like that.
21st is, yeah,
21st. Yeah. So that just tacks on. And what's fascinating about that, if you've been a good steward, we saw a lot of people, for example, in 2008, things went haywire. They lost their jobs. Even in 2020, 2021, you could weather that storm in a much different way. If you have been a good steward of this product and you paid off 50% of that line of credit, and you have 50% of it available and you lose your job, it's just going to tack the interest on for 2 and 3 months. Whereas if you don't make your payment on your conventional mortgage for 2 months, there's going to be a notice on your door. They're going to start the foreclosure process. This one, you have all of that equity. Hopefully you're trimming down your lifestyle because you know that you're in dire straits, but it's just going to add on a little bit every month, and you can weather that storm until income starts flowing again. So I think it actually provides a region of safety and, through emergency times.
100% does. I mean, a lot of the mental mind shifts that we see on a product like this, we're seeing people say, oh, like they're almost kind of gamifying their debt payoff on their home, which is, one of the last things that people are trying to pay. I mean, yes, people are trying to pay off their home, but if they have all this other debt, they're not focusing on, hey, how do I pay off my home faster? They're saying, hey, I want to get rid of this high interest rate credit card debt first. But I have people call me and say, hey, this loan's awesome. My wife and I kind of say, oh, do we really need to buy this new purse or new pair of shoes or whatever? And we're just watching our balance go down by $4,000 or $5,000 or $6,000 a month. And their household income, we're not talking about people that are making $20,000 a month. We're talking about people, just everyday people making $5,000, $6,000, $7,000. But because of the fact that their balance is just falling so fast, they're not adding new expenses. I've had people call me and say, I understood the loan. I kind of had my own little misconceptions about it. I knew it was going to work, but I just wasn't expecting it to work as well as it did. I was able to buy a home for my mom and dad to get them closer to me because they were on the other side of the state, or this or that. And it just kind of helps you really treat your life as like as like you're in control of all of it. Like you're treating your home and your finances like a business, as opposed to just treating it as this passive account that you just have money come in and money come out of.
Yeah, I think of that as, I'm sorry, you froze, so I don't know if I cut you off, Harrison.
No, you're good.
Were you still talking? Okay. And it's almost like you get the dopamine hit on the positive effect of watching your balance go down, rather than getting your dopamine on the excitement, the 20-minute excitement of the new shoes.
Exactly.
So you're kind of shooting that reward center.
One thing that this is making me think is, when I think about the 30-year mortgage, I'm talking about a primary home here, something that's not generating income for you. The more I learn and the more I understand cash flow, time value of money, opportunity cost, I really resonate with the idea that the 30-year mortgage is such a powerful tool because you're locking in a depreciating rate or a devaluing amount of dollars. And so the idea of like paying off a primary home 30-year loan early is never mathematically optimal, even though people psychologically want to do it because they want to see that reduced interest payment. But you're real, if you isolate it solely to the net present value discount formula, you're making the banks a mint by paying off your home early, because you're paying them when you make that early principal only payment, you're trimming it from payments they were expecting to get in 30 years. Correct. So their value getting that money today is enormous. And yes, you save your interest, but you save yourself on the 30th year. They profit enormously on the fact that those payments are on this present year, right? And so I typically view, if it's not an income producing home, like a rental property, when I view, and I don't have a primary mortgage on a home right now, but when I have one, if I lock in a 30-year fixed rate mortgage, I don't want to pay a penny early because I can make much more with those pennies now, the same way the mortgage company will do, because they're saying, hey, I thought we were going to get this $2,000 in 2060, 2055, but now we're getting it today. This is amazing. We'll grow this for the next 30 years, right? But this flips it, because in this case, paying down your mortgage early, you're just unlocking capital. You're unlocking equity in a way that, if you pay down a primary home early, well, that's great. You save interest over the course of 30 years, but unless you go to a bank and get a HELOC, you have nothing you can do with that. That's locked away in inaccessible equity. That's an asset on your balance sheet, on your net worth statement for sure, but it provides nothing in the way of cash flow. Whereas this, paying your home early, that actually resonates with me because you're unlocking that equity that you can use now. But that brings me to a question of the interest rates, because you said on the 21st, it adds an interest rate for the previous month or for that 30-day period to your balance. Is that correct? And how are those interest rates calculated? Is this flexible more, or like, do your rates for this each month track with the general market rate, or do you lock in like a percentage on day one, and then you can chip away that percentage as you, or not chip away the percentage, but you reduce your carrying costs essentially each month by having money in sitting in the checking account. Like how do interest rates work with this?
Great question.
Like the
So
market rate for towards this?
yeah, so the payment obviously for the month of September is going to be every day taking your balance, multiplying by rate, divided by 365. And it just ledgers that on the side. It adds it up, and then that number gets paid out or pulled out on the 21st of the following month. However, the interest rates on this loan, yes, they do adjust. They adjust on a monthly basis. And that is based off of something called the 30-day SOFR, SOFR, the Secured Overnight Funds Rate.
Yep.
The way that those are looked at is, and that essentially replaced LIBOR, and there's a bunch of other things that we can get into that perhaps in another.
Yeah, we just did an episode on that two
Yes,
episodes
perfect.
ago, I think.
So go check that one out. But at the end of the day, when we look at the rate, we say, hey, on the first business day of any given month, we look at the last posted date that the 30-day SOFR was. And then we take that and we add that to a margin. The margin is the choice on your behalf. It is as low as 2.5% and as high as 4%. And that moves in 0.25 increments. So 2.5, 2.75, 3, all the way up to 4. You can choose to buy your rate down by choosing a lower margin, or not buy your rate down and taking a higher margin. We add those two numbers together to get you your fully indexed interest rate. That interest rate today in the month of September is easy math, between 6.4 and 8.3. Now, numerically, those numbers are higher than 30-year mortgages, but because of the calculation done on this loan with how it's based off daily interest or daily balance, the effective interest rate, how we can compare it to a 30-year mortgage, what an individual spends in interest on this all-in-one product, in many instances, is as if they are receiving 30-year mortgages at rates below 2 or 2.5%. And that's kind of the major factor on this product. Because at a 5.625, you spend about 100% of what you borrow in interest. And today, if we had a 5.625 interest rate on a 30-year mortgage, that'd be a good interest rate today. However, you spend about 25% of total interest in just the first 5 years. The likelihood you're even in a home for more than 7 years is pretty low, statistically speaking. So you go, oh, great, rates are at 5.625, been in the product for 5 years. Yeah, well, you spent on a $400,000 loan, you spent $100,000 already. Well, what if we could shrink down your total amount of interest expense on a product to just $100,000, and you pay the home off, meaning you no longer are spending that money, meaning you're keeping that other $300,000 in your pocket.
That's an interesting, it's funny you said that, because I did my thesis at Harvard Kennedy School on mortgage disclosures for the Central Bank of Ireland. And I still on my main, I got it right here on my spreadsheet, like my main planning spreadsheet. I keep these numbers on here front of mind because they were the primary three takeaways. The idea of the thesis was to improve consumer understanding of the mortgage product in the 5-page disclosure for the Irish market, but in practical, it's the same market, it's the same structure. So at the time it was a 4% rate when I did the thesis, and I keep on here, month 153 at the 13-year mark is when your principal exceeds your interest. And at month 231 at the 20-year mark is when you've cut your principal in half. Now, those numbers, and my intent with this at the time, before I understood any of financial physics the way I see it now, my intent was to say, hey, look how much you're spending in interest. Like your total volume of interest on a 4% loan is not 4% of the home purchase. It's like 70%. And my thought at the time was, this is why it's valuable to pay it down early. So honestly, when I go back and read that, I'm like, these stats are things that people should understand. But my takeaway now would be different. But the other stat that was one of the main points of this was the average turnover in the Irish market was 7 years. And that's funny you said that same thing. Like that is the statistical number. And that's why these front-loaded loans are so profitable, because all of the conversation we're having about I'm saving interest down the road, et cetera. If you actually live in that home for 30 years and pay it off, then these principal only payments could make sense if we're looking at a 30-year time frame. But if you sell the home in 7 years, you're giving them money that's 23 years time discounted in full today, rather than the extreme discount that they would expect to get in 23 years. If you don't, like, all of this conversation about paying your home off early, which is not the conversation we're trying to have, but it none of it makes sense if you don't live in it for 30 years. And that statistic of 7 years is so powerful. So that's why this is so intriguing, because this decimates all of the arguments for getting like the positives of 30-year mortgage, which I agree with. If you're in the home for 30 years, like all of these things are out the door. So we have to reset our and like you said, we always say, rethink your thinking.
Yeah, I like that.
You have to change what you think you know about mortgages, because a lot of these truisms are totally flipped on their head when you think about the power of this product. And I'm just very impressed. Like, as I'm actively learning about it, this is a total game changer. And I'm excited to talk to you about trying it for my rental properties and seeing if it makes sense. And in the future, when we move, because this is like all of our thoughts about fixed rate mortgages. Oh, is this an adjustable rate every month it pays, whatever. You're comparing apples to oranges, because you're not staying in that home for 30 years. So you don't even get to make these, I saved this much in interest. No, you didn't. You moved 7 years in. You didn't save anything in interest. In fact, you paid out the ass in current net present value dollars. It's like, this is a game changer. I love it.
Totally. I mean, one of the really crazy things about so I'm going to kind of take a step back. There's a bunch of stuff that you said that I kind of want to unravel. One, 30-year mortgage is a great product for people that need to get into a home. By all means, if your intention is, well, I want to buy a home, but I need to do it in this first lien HELOC, you're going to be waiting for a heck of a lot longer than you probably should to get into a home, and you're missing out on the appreciation. Build the game plan into figuring out how you can get into it, but just get into the home. When you do get into a home and you get that loan disclosures in a 30-year mortgage, you'll receive a loan estimate, and then later down the line, you'll receive a closing disclosure or a CD, LE and CD. On those pages, the second or third page, you'll see at the top, it'll say something TIP, which means total interest paid. And that'll show you that 70% number that you just talked about. What's the total interest you're paying compared to the mortgage or the loan amount that you're getting? And when you start looking at it, you go, well, wait a minute. I thought you said that I had a 4% interest rate, but you're telling me here that my interest expense is actually 70%. And if anybody's listening to this and they're buying a home, look at your loan estimate. Take a look at it. Be sure you know what you're getting into, because the people that taught you to get into 30-year mortgages are the same people that are overly benefiting from you getting into a 30-year mortgage.
Funny how that works.
Yeah.
It's volume of
Because at
interest.
7%, you're more than 100%. I mean, I don't know exactly where the cutoff is, but it's not like you have to get to a 15% rate to where your total interest percentage is over 100. I think it's like in the ballpark of 7%. You're basically paying for the property twice in interest.
5.625, I think, is where you pay 100% of the borrow or the borrowing.
Really? That's crazy. That's even less than I would think.
Historically, that's considered low.
Yeah.
You know, I'm not talking about this window of 2008 to 2023 that was like insane and has never happened ever. I'm talking about go all the way back, you know, to when a mortgage first appeared. That was low. 5% was low. I mean, people were buying houses in the teens regularly in the 80s and 90s.
Yeah. That's crazy. This is awesome.
Yeah, and I mean, and so think about this. Like, I don't know how much time you have, Harrison, and I know that you have something going on here. So. Okay, like a cool thing to tie into this, like for me, so I have a lot of premium that I pay for the policies that we have in our infinite banking system for my family. Well, what I used to do, and this is not a knock because I still think Currents is a phenomenal system, and I know Harrison, you might not be familiar with that. It's a cash flow strategy that is incredible at helping people save a lot of money. And I did that until I took out the loan with you. And I'm going to go back to it someday when this house is paid off. But now when I save that capital, that's going to be future premium. So a lot of our clients pay annual premium. And let's just say they have a $20,000 policy. That $20,000 is depositing into this mortgage all through the year. And then once a year, I pay my premium out of this. So it is saving me interest that remains accessible by paying down my equity for 12 months. And when I pay my premium, yeah, the balance goes back up, but it benefited me twice because it benefited me by lowering the total interest charge through the year. And it benefits me by depositing into my personal banking system when that comes due, rather than sitting in a savings account somewhere at 1%, 2%, 3%, whatever you can get out there right now, waiting to deploy those funds into the banking system. So that's one way I'm optimizing it. And there are plenty of others that can easily be used where, you know, I can ultimately, and I probably will ultimately just take over this loan, you know, with a policy loan and just pay off the all-in-one. and now I own the debt, and I'll just start flowing all that money, and I can still keep this open. That's the cool thing.
Yeah.
This is a 30-year loan. When
Yeah.
I pay it off, it's not closed.
No. Yeah, no, that's the really cool thing. I
Yeah.
mean, sorry, go ahead.
Oh, no, go ahead.
Yeah, I mean, one of the cool things that I've been looking into is, okay, well, let's say you wanted to, let's say, Hans, you had plenty of equity in your current home. I obviously know you're renting right now, but let's just say you had $150,000 or $200,000 of equity in your home, and you had this loan. What you could do, and what we've seen people do, is they'll start a policy. They'll dump all of the money into the policy. Then they'll have access to that 250 grand still growing at 250, but they'll then take the loan against the policy and pay for the property cash, so that they can then have these two assets, one home, one policy, still growing. And then after they pay for the policy in cash, what we've seen people do is say, great, now I know my rental income on this property is $1,500 a month. I want to be positively cash flowing $250 a month. Then they'll just get a loan of whatever it is that's the net difference between 1,500 and 1,250, whatever that loan amount is. And then they just put that back either into their policy or they put it back into their home. So they're taking advantage of these tools that, again, everybody has access to them. It's not like you, just because you are just this person that's this, you get this special treatment, you have access to it. If you qualify, you have access to it.
Yeah, that's really cool. What about just talking about interest rates in general, not specific to this product necessarily, but obviously as of this week, because when the announcement was the 25% basis point cut, what, people have this expectation still, and this gets into LIBOR versus SOFR and the new system. And our podcast episode a couple ago was all about the idea that the Fed doesn't have as much control over the rates that matter to us as consumers as they used to, due to the more market forces that were kind of injected into the SOFR process. And so the mortgage rates people were like, oh, well, the Fed's cut rates, so now homes will get more affordable, or people can afford more homes, so prices are going to go. Like, that doesn't really happen. And what have you noticed, and what do you generally see as far as, knowing that the mortgage rates are based on the 10-year and not necessarily on the Fed funds rate? How have you seen the last couple, let's say, Fed rate hikes and then cuts impacting your rates? Because we need to understand collectively what the mortgage rate is based off of, because it's not just as simple as Fed cuts rates, mortgage rates go down,
Yeah, I mean, it's kind of like, it's not like how it used to be when, hey, rates are going down, so rates go down. These last few years have been kind of unique. Yes, it's based off the 10-year treasury and the 30-year mortgage-backed security. It's almost kind of like the announcement that we perhaps are going to have rates lower sparks rates coming down well before the Fed actually announces the rate cut. In fact, it's weird. I watch videos of these people who are like professional body readers and linguist readers to determine if there was uncertainty in what the individual Powell or whomever is talking about, to determine if they're actually going to do what they think that they're going to say, because they're so vague around it, which I just think is incredibly fascinating. But the hype around the potential rate cut actually, from what I've noticed recently, has actually sparked rates moving down well before rates have actually gone down. And in many instances, sometimes the Fed actually does the rate reduction and the market goes, oh, we lowered rates too much. Now we kind of got to come back up to where they said that they were going to do it, because we were expecting it to be here, but they only did it to here. So we've really seen the market have this level of distrust with the Fed's announcements, at least from what I know. Obviously, I can't talk about 20 years ago all too well, but it seems like it's kind of like the wild, wild west right now.
That's that free market, when you have a body reader interpreting one man's speech to see if the market might go up or down. It's like, how are we even pretending that this isn't a centrally planned economy? Like, that's physically possible.
Yeah, no, it's crazy.
Tell us about some practical applications. Like, I remember when I first talked to you, you showed me a chart of an actual client of yours. Not who they were or what they did, but like how they utilized this 3 times. And if I recall correctly, like they bought a rental property, they paid for their kids' college, and they did a couple things. And it was like you actually saw their mortgage balance go back up as they paid those big things and paid it back down. So, like, can you give some practical applications of how flexible this is? Hans likes to hit a lot of the theory, and we could talk about SOFR and LIBOR, but I also want to talk about, like, how does this benefit a family?
A real
You know what
person.
I mean? want to make sure our customers hear both sides of that.
Yeah, I mean, again, depending on if the person owns a home or refinances a home, for the most part, I guess it doesn't really matter. As that person goes through the process of paying their balance down, they're building up that available equity. As that person decides, hey, look, we've had this car for 10 years, we need to get a new car. Well, let's compare and contrast. That's all it really is. Let's look at the math on if we did it with a car loan, or let's look at it if we pulled the $40,000 in our home. Well, if we pull it out and do a car loan, then our payment's going to be X, $700 or whatever it is. We pull it out of our all-in-one loan, yes, we owe slightly more on our home, but the expense that we're experiencing is $200. Well, that net difference, $500, if they chose this way, they're having that come out of their account, but their balance is lower. But they're not saving as much money monthly. In this route, yes, their balance is higher and their payment goes up slightly, but they're saving a drastically larger amount of funds as they were hopefully, alternatively going to be spending elsewhere. That may allow for that person to pay off not just the home and the car with less overall interest than if they had the car loan and the home loan. But again, as that balance comes down, it's what is the next thing that I need to spend money on? Okay, well, we have 150 grand. Let's go buy a rental property. Now we're creating a new engine that can put money back into our loan. Now we need to send our kids to college, and we're paying for our kids to go to college. Well, we could get student loans and we can have those deferred for a little while if they're, there's all these, I'm sure you guys have probably talked about that as well, but there's all these different ways to go about it. Or we could just say, hey, look, we're just going to stroke the check for the whatever, I don't even know what college costs nowadays, $9,000 a semester or whatever it is. And that balance goes up and they're paying for their kids' college education. And then as they earn their money, it's coming down and it's doing this zigzag. So like the real life applications is, yeah, it's probably possible that you spend a little more around anniversaries and birthdays and the holiday season. But, if there's nothing major happening in March, nobody's going to be spending all of the income that they're making in March as they would be in November and December when they have those higher expenses. It's not always save money every single month. It's just, hey, can you consistently, on more occasions than not, save money? And those months that it's higher, slightly more expensive, take advantage of those. Live your life. So it really kind of just depends.
And I like to think of this as in somewhat parallel to with infinite banking in that, like, for example, we've talked about on this podcast, I bought a nice little piece of property directly behind mine. And I took a policy loan and I also took some of the equity from the house whenever I paid for that. I paid for it in cash. So either one of those systems, if I use a policy loan to buy a property with cash, I own that property. And nothing else I do that goes wrong can have that property taken from me. Like for example, well, I guess a total bankruptcy could, but if I bought a car, I have the title to that car. So if everything goes wrong and I'm gonna lose my house, I still own the car. So I'm not losing my house and a car. So I think of this in a lot of the same way. Like when I'm operating through this mortgage, my mortgage is the only thing. My home is the only thing that's leveraging everything else. Whatever I use it for, I own. I own free and clear, unless I'm just using a down payment, for a property out of this. It depends on how far I take that, but I own the cars. If I go buy a boat, I have the title to the boat. And if I've been a good enough steward of my money to the point that I do have a large cushion within this and everything goes wrong, I have one payment. And like we talked about, that payment, that interest charge can just continue to roll as long as I don't stay so squeezed with so little equity in my house that it's going to upset the balance. I can ride out down waves for months and months. I mean, technically, if I paid off half of this mortgage, I could probably just sit back and put no money into this for years.
Totally.
It'd be stupid, but I could do it.
Yeah.
And it gives you a lot of flexibility, control, which we always talk about. Not being a passenger, in your financial life. Like it gives you a lot of flexibility and control through all the ups and downs of life.
And I want to just, mechanically speaking, a question that, I know the answer, that there's not a fixed monthly payment. We already covered that. But when you said, to go back to the example you said, if I go to the dealership and take out a loan, finance with them, and I have a $700 a month, in expense that I incurred, you compared that to, well, if I use this HELOC, basically use this mortgage product to fund the purchase of the car, I might only increase my spending by, say, $200. And by that, did you mean you've increased the amount of interest that's going to be recurring, but you're not actually incurring an expense that's like a regularly occurring expense. You're just saying that you might have added $200 a month in interest to your mortgage. And I just want to clarify that, because that to me, I was like, wait a second, what is, because that made me jump to, oh, did I miss that? Am I actually still paying a mortgage, and I've increased the amount of that monthly payment? But no, it's just that your interest charge, your carrying charge is a little larger.
Yeah, exactly.
Is that
So
right?
just, and you can do quick math at the end of the day. If the interest rate, just easy numbers, let's say the interest rate's 7.8%. We take 40,000 multiplied by 0.078 divided by 12, that payment's $260. So now you go, great, this $40,000 in a vehicle is going to be set. I don't know what the number is, right? Because I would have to go and look online, 62 month or whatever it is, or 60 months, 72 months. That's going to be a different payment. What's the principal reduction on that versus the principal reduction on this? If it was 700 and now it's 260, well, the net difference between those two is all obviously always going towards it, but your normal income's going towards it as well. So you're wrapping all of it into it. It's hard to say, like, let's segregate that mentally of this 40 grand, even though we owe 200 over here. It's all in one spot, and you're going to pay that $40,000 with your normal cash flow.
I know that I could tell you're a mortgage guy because you said, let's pick a simple number here. Let's use 7.8%. I was expecting 5% on like an even $10,000 purchase or something that most people need, but you're obviously very fluent with the numbers.
Sorry, I apologize.
You're easy.
I just say anybody can do that math, and it could be whatever the number is, right? Like the fast math is, okay, well, what's my payment going to be if I owe 250 grand? Well, 250 times 0.078 divided by 12. That would be your interest only expense. And then, when we talk to individuals, it's what's your value? What do you owe? What's that line of credit? Now we understand what that difference is. What other debt do you have? What does that add up to? I talked to a guy a couple months ago. He had about $120,000 in other debt, but he had like 400,000 of available equity if he was to do the all-in-one. That 120 grand was costing him $3,800 a month. Whereas, and yes, he was in a 2.5, 30-year mortgage. But when we looked at the mortgage plus that 120 grand, and we looked at the principal and interest, and we added it to the $3,800, just switching over to this, he's saving an extra like $2,000 a month in expenses that he otherwise wasn't able to save. I'm making my minimum payments. I haven't been able to pay this down. The last 12 months, my balance went from 90 to 120. And it's okay, so you don't really have a plan to paying these off. You're just making the minimum monthly payments. You're just kind of scraping by. So what happens if you had this unnecessarily large expense come up? You're kind of running with your back against the wall, and you're too afraid to touch this loan because you have such a low interest rate. You have all this money that you can use to put you into a much better position. And that person was like, whoa, that is completely crazy. You're telling me that now I can pay my home off and pay all this debt off, and it's only going to be in the next like 11 years as opposed to maybe paying it off if I win the lottery? It changes people's lives.
Yeah, powerful consolidation, man. Super powerful. As again, if you're a good steward, the place people could get ugly is if they're not disciplined. They consolidated all their stuff into their mortgage and then go buy more stuff.
Exactly.
So you just have to be a good steward. Go ahead.
I just want to circle back and like put a ribbon on this because I'm this might be a dumb question, but when we're talking, I want to go back to the car just one more time. You said we have 250K, we can calculate 7.8% on 250K divided by 12. That's my monthly charge. If I'm making that decision, and I'm going back to that, should I finance with a dealership? Should I do it with this? The difference there, when we're saying I'm going to increase my monthly interest charge by this amount compared to what I would pay the dealer, in that example, a $40,000 car, and I currently have a $250,000 mortgage balance that's accruing interest, I would say, okay, if I add this, if I pay 40 grand for the car, I take 290 times the 0.7, times 7.8% divided by 12. And then I subtract that from what it currently is, which is a 250K balance times 7.8 divided by 12. So that's my current interest monthly charge. If I add another 40 grand to that amount, this is what that's how we're getting that number where you said, let's say it's $200. Am I just?
Yeah, okay. No, you're right on par with that.
Okay, cool. So what about for, like, let's say in my situation, I have these rental properties and I want to have this conversation with you about, does this make sense for me? Or someone who's listening has a mortgage in their primary home. What does the actual process look like to start this with you? What website do we go to? How do we evaluate that with you? And then sequentially, we have this existing mortgage. We'll take that example instead of going into a new mortgage for the first case. How does that actually look? Like step by step, what are we doing?
Yeah, we're going to have a phone call. We're going to have a conversation. We're going to talk about how you earn your income. What is that W-2? Or are you self-employed? We're going to look at what the balance of the mortgage is. We're going to look at the value of the property. We have a simulator. By all means, we like to have conversations with people before we just start jumping into it, because I want to know all the intricacies. I want to know, hey, by the way, I work for my sister. I paid underneath the table, and that's my income. Okay, well, you can't get paid under the table because we can't really use any of that income. So I want to understand the person's scenario, understand what they're saving monthly. We'll then walk through a simulator. You can go and check out the simulator. Again, we have videos as well on our channel about how to do the simulator. It's allinOneLoan.com. Just spell it all out. That's how you test the simulator out. Obviously, we want to have a conversation with you. And you can go on there. It's pretty simple to follow. Hey, I want to refinance my investment property. You put in the value, you put in the balance. You go to your 30-year mortgage at what interest rate. You put in your net income and then how much you save monthly. And then it spits out the results. Hey, this is the remaining amount of interest you're going to spend in your mortgage. But if you, same person, have this product, this is what you're going to spend in interest. And it just tells you the two difference. Oh, I'm going to spend another $70,000 in interest on this loan, or I'm going to spend a total of $25,000 of interest on this loan. Is that net difference going to be enough to switch over to a product like this? We kind of want to look at everything at the end of the day to determine, does the math shake out? We don't want anyone to go into this just because they want to go into it, but it doesn't make sense, because that does them no good and it does us no good.
Yeah. I will say, having played with that calculator a lot, is there probably are scenarios where somebody locked in a really low interest rate a long time ago when it was low, and they don't have enough life on their loan left that like the volume of interest is going to make a big difference. But don't think just because you have a 2.753, 3.25% loan and you hear him say that number 7% and you're like, that's stupid for me.
Yeah.
Don't believe that. Like, crunch the numbers, because you may be, if you do have positive cash flow in your life, you very, very well may be way better off in this product, and the speed at which you can pay it down based on that positive cash flow, even at a higher interest rate. I had a mentor, this was way back when I first bought my first real estate properties, and he said to me, interest rates are interesting. It is the absolute last thing I look at when I make a financial decision, because does it cash flow? Does it work? Those are the things that matter. It didn't matter what the interest rate was. Mm-hmm. It matters if it doesn't cash flow. Then you're like, that's upside down. But I'm just warning, like, do not say, I refinanced in a 2.9. Like, I would never do that.
Yeah.
Maybe.
Yeah. The other side of the coin is, what's the opportunity cost of the thousands of dollars that's sitting over here that you could use somewhere else? Because in some instances, it could be a dead even, I'm saving no money in interest, but I have access to 250 grand over here. But that 250 grand could be deployed and making you more than what the interest expense on that money is, and you're still dead even. Well, now you have this thing that's deployed elsewhere that you're now paying off this debt again, but you've just built up this additional asset that you otherwise would have never had access to.
That's analogous to when we talk about when we're going through, someone kind of grasps the idea of infinite banking. Let's actually talk strategy for me. And we start looking at illustrations and what could make sense. We look at the illustration, we dive deep into the numbers, and we look at, people want to focus on, okay, well, what is the dividend rate? What exactly is the rate of return on here? The internal rate of return, the external rate of return? What's the dividend percentage? It's like, we're comparing this to a savings vehicle. And what I can't show you I can show you phenomenal numbers on this illustration, even in conservative estimates. This is, this is very powerful in and of itself. But what I can't show you on this illustration is what I'm doing with my policy, because I usually walk as a template. I use my actual personal policy in the illustration that I used, and I'll walk people through that. And I can say, here's what I'm actually doing. And that gets into a discussion of how policy loan mechanics work. Here's the rental properties that I funded through this policy. Here's the real estate syndicate I invested in through this policy. Here's the different ways that what's in this one single page of illustration, I can't show you the percentage cash return, which is hundreds of percent return on what I'm actually doing with these numbers. In the same way that, like you said, you might go to the calculator and find out that it's even. Like there's no difference in the interest on one versus the other. But what you can't do with your 30-year mortgage with X amount of interest is anything else. But that doesn't get into the conversation of with it's all in one. Even if I also have an equal X amount of interest, due to my very specific situation, I can't show you all the things you can do with the equity that you have that you can't do with your mortgage. So it's like, even if I have to pay a little bit somehow, I can't really imagine there's got to be some scenario, but even if I looked at it, I was like, okay, well, this is going to be 1% more total interest somehow on this property, which again, I don't, if that were to be a thing, I would still probably want to do this because of what I can do with it external. And if I can access that equity instead of just building equity for my balance sheet and no purpose, if I can build equity and then deploy it, like that's so powerful. And that's another, that's just like, that's beyond the illustration. That's beyond the mortgage calculator.
Totally. Yeah. I mean, I love saying the hyper efficiency use of money because it's a lot of big words, but it's also a lot of simple words as well. Because this loan gives you the ability, it is just a tool to use for whatever it is that you're looking at trying to do. Your 30-year mortgage is a nail and a hammer. You only have one tool and one thing that you can do with it. This is, what is it that you're looking for? Hey, do you think that you want to start a business? Well, you've got plenty of equity. Maybe this can help you weather the storm of starting your business and all the upfront costs and the marketing and getting all the, PPE associated with it. Then great, go use that, build your business. And now you've gone from been working for someone to working for yourself, or maybe your significant other is also working and your goal is to have them not work, or maybe you're trying to retire 5 years early, or maybe you're trying to retire just 5 years late and you don't want to push it to 10 years and you actually want to get to that point. This can be something without really needing to have, well, I had to start my 401k when I was 18 years old and now I'm going to be able to retire. It's, well, maybe something happened and now you're 45 years old and you don't have all that time and you still want to retire early, or you still want to pay for your kids' wedding or college education or their first car, or give them the Christmas that you've always wanted when you were a kid. This, in my opinion, gives those like the meaningful moments.
Man, this is awesome. Like this is, I legitimately, and again, I'll emphasize, I came into this conversation totally not understanding what this was, and I'm blown away. This is powerful, and I hope that listeners go to allinOneLoan.com because that's where I'm going to go as soon as we hang up here. I'm going to go check it out because I would love to do that with my rental properties if it makes sense. Because this is awesome.
And I can send you a link as well to schedule a time and all the other fun stuff as well. I'll send that to you guys.
Yeah, and that'll be in the show notes, of course, the calculator, how to schedule, anything you want us to put in there. Because I hope you get a lot of calls from this because this is super powerful and a great example of rethinking your thinking.
Yeah, it is. Harrison, how would you like people to reach out to you? Do you just want to say it? We'll put it in the show notes, but even if you just want to say it here, what's the best way to find you?
I mean, honestly, the best way and the easiest way to get a hold of me is you can either just call me, and you're more than welcome to just reach out via email. So my email is harrison@cmgfi.com. My cell phone number, my personal number is 925-785-6828. And there's plenty of links in the description as well that you guys are more than welcome to reach out to us with. And that's probably going to be the easiest way to begin.
Awesome. And as a last resort, you can easily just reach out to us and I'll set up I'll set up a dual email and introduce you guys that way too. So however you'd like, but yeah, I hope some people reach out because for me, it's been working. It's been awesome. I've got it paid down a lot. I've utilized it for multiple things. Like I mentioned a couple in here, I bought land with it. I bought a lawnmower, using the walls of my house. So, and that's just two things. I've done a lot. I pay for my premium by first depositing it into my house and then taking it back out. So It's been phenomenal. I love it.
Awesome.
Perfect. Well, I appreciate you.
Anything else?
No, I think that's it. I appreciate you guys even giving me a chance. Oh, sorry. Go ahead.
Is there anything that you wish we would have asked?
No, I think you guys covered a boatload of stuff. Obviously, Hans, you hit the really awesome kind of questions that people those niche questions that people are always kind of thinking about, but never really end up asking until maybe, a couple weeks into it. So that was really appreciated. And then obviously really appreciate you guys just giving me some time.
Yeah, man, I'd like to do it again. Let's plan maybe down the road here. We'll have you back on, and especially if we get some questions or if we think about some more things and changes, there's still probably an hour's worth of discussion we could easily have.
And we can walk through a bunch of other things, give examples, and I can share my screen and do a bunch of cool things.
Yeah, happy to have you back on again. So
a case study that would be a really interesting one. Perhaps even because my wheels are turning about how I can, like I said, take those rental properties. And so maybe I could try to document as much to make a case study out of this, and we can kind of explore. So perhaps in 6 months or something, if it makes sense that I actually go through with this for the rental properties, kind of walk through that process and make it, because so many of our listeners have rental properties and are probably thinking the same thing. How can I optimize this? And so that would be a cool revisit. But also, I mean, just checking in as far as the housing market, the mortgage, the lending world, I think is always good for our whole idea is that we want to connect people with people that excel in different areas of finance, because the study of macroeconomics and the study of personal finance should be a second job for everyone. Just like we say, you should be a banker. You should have your primary, income source job, and you should also be a banker for your family. You should also be studying regularly economics and finances, because it is the most important thing after your faith and your family, because it undergirds everything else. So I really appreciate you coming on, and this has been an awesome learning opportunity.
Awesome, guys. Well, I appreciate you very much. Thank you.
Yeah, man. Thanks. And hey, subscribe, reach out to Harrison, share this episode. Definitely. If you know somebody who this would benefit beyond yourself, share it with your friends and family and anybody you think that would like to unlock some capital and get it working for them.
Yeah.
Powerful. All right. You guys have a good one.
Yeah, you too.
All right, y'all. Cheers.
Thanks for listening to Remnant Finance. If you found any value at all in this episode, please subscribe, leave a review, and share it with a friend.
Remember, true financial freedom comes from taking control of your personal economy and breaking free from the status quo. So stop being a passenger in your family's financial future.
Boldly take back control of your wealth. Until next time,
this is Brian and Hans signing off.